Let's welcome in our next guest, Mr. Srivastava, CIO Fixed Income at Sundaram Mutual. Sir, if you could just tell us what is your expectation on the policy, especially with what's happened in the demonetization. Commentary of RBI governor would be very important.
Yeah, I think right now the market has already discounted about 50 basis points from a steady state of repo rate. And if you look at it, I think a cut will not be what the market will be looking at. Market will be looking at what is the commentary from RBI. And since the last regime has changed and the new governor has taken over, there is very little communication between RBI and the market. So market would be all ears to hear what the governor has in mind and what he wants to talk about demonetization as a move from the government.
In terms of rates in the system, your 10-year yield has already factored some rates decline. What is the rate estimate that you have?
I think market largely is expecting 25 basis point, and a minority of the market, or rather 20-25% of the market, is expecting 50 basis point. But we are not expecting anything. I think the reason why we are not expecting any rate action is primarily because of the fact that demonetization was a planned move, and they would know what kind of impact it would have on the growth rate. And it is obviously understood to be temporary in nature. And going forward, what we believe is that most likely this will have a better impact on the GDP in terms of the informal economy getting into the formal economy, cashless transactions happening. So it will have a far-reaching impact going forward. So we expect that this is kind of planned, and growth rate in the meantime already has been factored into. And the last move of rate cut was very well versed on the inflation. And if you look at from the last time, what has changed? So in the global context, we have a Federal Reserve who is on the verge of raising rates, which was kind of factored in, but with a more aggressive outlook from the Trump administration. And again, we do not really know what Trump administration will be able to do, but it will be wise to wait and watch, particularly in backdrop of the commodity prices also rising, and India being a net importer, we have to take this rise in oil prices as a major thing. And if we have to go by RBI commentary the last time, both on the rupee front as well as on the oil price, the governor had spoken about, in fact, Dr. Urjit Patel being the deputy governor at that point in time, it said that India is in a sweet spot when the oil price is between $40 to $50 a barrel. And obviously, a corollary to that would be that when it goes beyond 50, obviously India's current account gets impacted. Number one. Number two, the last monetary policy report had factored in the depreciation of rupee. They had spoken about the impact of rupee depreciation. Every percentage depreciation adds directly to the headline inflation by 15 to 20 basis points. So if we have seen already about almost 3% depreciation in rupee, now it is about 2% depreciation right now. So almost about 30 basis point or 20, 25, 30 basis points of direct impact on headline inflation. And if oil prices keep on rising or they remain here, it will be an issue going forward.
Right. How would, the point that you made that, what will the monetary policy think about demonetization would be utmost important. So whether they see it's a temporary effect, maybe 1 or 2 quarters, things would get normalized, or it would have a more enduring effect, whether it is a supply side issue or a demand side issue, how essentially would you read into the commentary of demonetization?
See, there is a lot of speculation right now. If you ask me what is demonetization going to do going forward, there were a lot of speculation the day it was announced. We have already been about a month through demonetization, and we know what are the numbers which are stacking up. So the point is that it is right now very speculative to say what it will do, but definitely from an economist point of view, what we know is that some amount of this cash in circulation will come to the banks, and this will become a formal economy. And knowing the fractional reserve system of the banking, it will help in future GDP growth. So all these factors going forward should also one of the major intentions of this move could be a behavioral change in India. So as touted in the press the day this move was, that globally it is about 12 to 14%. Globally it is about 3 to 4% as a percentage of cash-based transactions, and in India it is 12 to 14%. So obviously, if this figure is bridged or this comes lower, it will help India to take this money to the banking system and probably faster velocity going forward.
Right. In terms of what MPC had said earlier is that they had already expressed their concerns about slack in the economy at the October review. So now their growth estimates, their inflation estimates could come down quite materially.
Again, as I told you, that in the short run, definitely it will have an impact, because we know in the channel checks and all that things have slowed down because the businesses which are cash dependent. But how much of that is reflected in the CPI is an important thing. So the point is that is it going to have a material impact on the CPI will be one thing, and will it have an enduring effect on CPI will be something which we need to figure out. And I think RBI will be looking into that whether this will feed into the CPI number for the coming quarters, and if that has to be mitigated, probably a 25 basis point cut could be something which RBI could be looking at this point in time. Maybe not now, maybe in the February policy, or maybe a bigger cut in February policy, because by then we also will know what Federal Reserve has on its mind.
Right. In terms of liquidity in the system and what's happening with the banking deposits, you expect some measures or at least some announcements to come?
I think this is when this incremental CRR was announced, it was clearly mentioned that it is a temporary measure with MSS ceiling being high. I think most likely a rollback on CRR is on the cards, or a partial rollback on the CRR is on the cards, depending on what kind of liquidity exercise they need at this point in time.
In terms of the liquidity, or say if 10% of the money also stays back with the banks, what do you expect to happen to rates in the system?
See, rates, in fact, we have seen this not now, we had seen this earlier as well. RBI had cut rates by 100 basis points, and the impact on the bond yields was marginal. In fact, the money market yields were also pretty obstinate at that point in time, with RBI intervening in the domestic market, inducing liquidity, coming to a conclusion that the liquidity needs to be brought to a neutral status. And from that time, without moving the repo rate, we have seen a sharp decline in the rates. In fact, demonetization, post demonetization, we have just seen a decline of about 40 to 50 basis points on the bond yields, while on the money market yield buckets we have seen about 30-40 basis points, and now it is stabilizing at these levels. So even if, as I told you earlier as well, so market is completely discounting about 50 basis points from a steady state perspective. What we measure in the bond markets is a spread between the repo rate and the 10-year bond yield, and typically in a steady state it clocks at about 40 on a median basis, clocks at about 40 basis point to 50 basis point. So I think liquidity itself has done its job, and liquidity definitely helps the system to absorb, percolate down the rates. But what needs to be monitored very closely is the banks should be looking to pass on these rates to the borrowers.
Right. But Mr. Srivastava, can you tell us why you are not expecting a rate cut, you're expecting a status quo? Will that be very negative for the markets? Because the differential is, like you mentioned, with the yields and the current repo is quite significant.
Yes, I think it may or may not be negative depending on what RBI has to say. If RBI continues about and acknowledges the fact that even if they don't move the rates and the liquidity remains in the system, and simultaneously they give a commentary which is dovish. The impact will be there because market is already discounted, but it may not be a very exaggerated response compared to what the current level of yields is, and as market will keep on expecting future action from RBI in the coming policies.
Right. And what do you expect from the RBI when it comes to transmission? Because that has been a point where the previous governor has spoken of quite a bit. Now we've already heard of the banks announcing, SBI has announced a huge cut in their bulk rates. So deposit rates have started to come off as well because of the inflow of liquidity. Do you think transmission will be better this time?
See, I think it's a bit coercive at this point in time. If you look at it, the savers also need to have rates which can sustain them, and at this point in time, cutting bulk deposit rates by the quantum which RBI with SBI has done is primarily to manage liquidity in the short run, I think, and it may not be a long-lasting measure by SBI and similar banks. Later on, what we need to figure out is what the real rate of return is. Now that is, and particularly when you're talking about the transmission, last regime to this regime, there has been a significant change, and the thinking is entirely different because now the rates are decided by a committee, which is going to govern the rates going forward, and it itself is dovish. So the point is that going forward, we may see a regime where we.
Yes, please go ahead. You're saying going forward, you may see a regime where?
Okay. We may see a regime where it is the rate action is more dovish in general, and this is going to we have to see, because this is the last policy was the first policy of the governor, and going forward we have to see whether the RBI has a different view or not from the Monetary Policy Committee in general, the outside members on the committee. So it will be very important to see how do they think, and do they resist the outside members of the committee if they are talking about more rate cuts going forward. I think this again depends on a host of factors. What are the level of interest rate which should be in the economy is not governed by Indian domestic factors alone. They are governed by the global factors as well. And if the global factors are turning truant, we have to take cognizance of that, and we have to act accordingly, and particularly when we are net importers. So that is something which we need to figure out. Right now, the macros are in a fantastic condition. India can bear more volatility on the forex compared to what in the past we could have done. Our forex reserves are in a healthy shape, but things like these don't take much time in changing, and savings to GDP ratio is stuck at about 31%. And what we need to also figure out right now is that we need to increase the savings to GDP ratio going forward. And again, a very fast action on the rates going against the global factors would be counterproductive, I think.
All right, Mr. Srivastava, thank you so much for speaking with us at NDTV Profit, giving us your views on what can be expected from the RBI when the policy announcement is made a day from now.